So now we're going to be talking about the PDT rule, a margin account versus a cash account, and how much money you should start with. So first of all, what is the PDT rule? So if your account is funded with less than $25,000, so this applies only to brokers that are in the US. So TD Ameritrade, Webull, and other brokers based on the US will have this PDT rule that will be applied. If you're a broker like Trade Zero that's based out of the Bahamas, this will not be applied. But most brokers that I use, for example, TD Ameritrade, Webull, Robinhood, are all this rule applies. So if you're limited to 3 round trips trades, so what does 3 round trips trade mean? That means you buy and sell within the same day. So let's say I buy a stock at 6:30, I sell at 7:30. That's 1 round trade. So I can only do that every 5 days. So why is that important? In a momentum-based strategy, in a strategy that we like to take a lot of trades daily, as we're day traders, this can definitely affect us, only being able to take 3 round trips every 5 days. So that pretty much lets us have 3-day trades every week, right? So and most people will start with less than $25,000, so that's a big ask and a big setback for most people. But we're going to be talking about some ways around it and what we can do to avoid this day trader rule. And why does the US do this? Well, they do this because they want to make sure that people are not over trading if you're inexperienced, and if you think if you have less than $25,000, it means you're inexperienced. So that's the main reason why they do it. So how can we get around the PDT rule? Well, first we're going to have to talk about margin versus cash account. So what's the difference between a margin account and a cash account? Well, a margin account only applies if you have the PDT rule. So the PDT rule only applies if you have a margin account. If you have a cash account, the PDT rule will not apply. As it says here, subject to PDT rule. So what is a margin account? A margin account is usually what your broker sets you off right away. So let's say you have $1,000, a margin account, let's say you take a trade, it's $1,000, the same day you take another trade, it's $1,000. The margin account gives you pretty much the broker giving you money as something like a loan. Right, so they're letting you use their money to keep trading and not having to wait for your cash to settle. So kind of like a bank, you put a cash $1,000 in your bank, you gotta wait a day or two, and then it settles. Same thing with a broker, but if you have a margin account, the broker is lending you money to keep taking trades. So can use more money than cash account. So you can usually buy a lot more than a cash account. So because you can leverage more money that's in your account. So you have 10,000, like margin account, you'll be able to use up to 30, 40, 50,000 because you can keep taking trades. And depending on broker you use, they have different leverages. Some broker only lets you use 3 times the margin. So 10,000, you can use up to 30,000. Some brokers even do 7 times. So other than 10,000, you can trade up to 70,000, right? But it is subject to margin calls. If you go too much over you're supposed to use, they'll call you and say, hey, you gotta pay back your money. So it's more dangerous to use the margin account because you're pretty much trading. If you keep over trading and trading too much and trading too big, you're gonna be trading with your broker's money, and if you keep losing, you might be lost more than you actually had in your account. And obviously you must have that $25,000 for the day trade. 4 times buying power is usually pretty standard. Some margin accounts have some fees, not the ones that I use, but some of them do. And also another important one can, if you're short-based strategy, you can short sell. So you cannot short sell on the cash just because if stock goes parabolic in the opposite way of your shorting, you want you to have a margin account, and if you're down too much, they'll give you that margin call that you really don't want. So the main thing to the margin account, you gotta be careful. You can lose more money than is in your account. If you're inexperienced, you don't know what's going on, you keep trading, buying, you don't know what's going on, you'll end up losing too much money. So as a beginner, I try to tell people start on a cash account so that you don't run this little risk that you have with the margin. So cash account, why is the cash account so good, and why do I recommend it to most of the new students? Well, cash account is so good because it doesn't affect the PDT rule. So the cash account works like this. Let's say you have $1,000, right? Let's say you have $1,000, right? And you use 500 to trade one day. The next day, you'll have 500 only. So what is that? So you only have 500 trades. Why? Because the other 500 is waiting for it to settle, kind of like a bank. So you use that 500 trade that day, and at the end of the day you have 0. And then the next day after that, so the second day, you have that you have that first 500 back, right? So you have 1,000, use for the first 500. Next day you have 500. To that day use the other 500, so you have 0. And the next day the first 500 you use on the first day is back. So every other day your money is back. You need to wait. Usually it's 1 day for it to settle and then it comes back. So it's also good because you can only lose the cash you're trading with. But if you have a short selling based strategy, you can short sell. And I recommend the cash because most people will not be over a PDT rule. Most people start with a few $1,000s, 2,000-3,000. You can use, especially at the beginning, you don't want to use all your account to begin with. Use your total and learn. So using 500 each day is a good way to, one, minimize your risk because you're only risking 500. And two, no, take as much trades as you want. You can take 5 $100 trades that day rather than margin account. You can only take 3 trades for the whole week, right? So usually I recommend people to start on a cash account. And if you're under PDT rule, it will really help benefit. And also, we're gonna be talking about what much money you want to start with. Well, starting with some money is better than none. So I'd say you have a couple $100 saved up. That's better than nothing. At least you can get your training in. You're not risking too much. I want more students to start with not too much money. I'd say you can invest 30,000. Okay, you can deposit it to be out of the PDT rule, but I want you guys to start small just because you want to get the emotions of the way. Because if you down only a few bucks, you're not going to get emotional. You're going to start focusing on the trading and you're going to start focusing on the actual technical and setups and not just so much about the money. If you start a lot of money, you're down a few $100. As a new trader, you'll be more emotional than an experienced trader and you're going to forget all the technicals, all the things we've taught you, and you're going to throw that out of the window and you're going to get too emotional. So I want people to start with smaller, especially when the first trades, when you're learning, is better. Of course, if you have more money, it gets easier to make money once you get more experience. So I want you guys to start, let's say you have 1,000, start with 1,000. Once you get comfortable with that 1,000, add another 1,000, 2,000, 5,000, and so on. So as more you get experience, the more you get comfortable with your emotional aspect when you're trading, with the money you're putting up, you're not getting scared of it, you can keep adding on and you'll learn step by step, make money step by step. You want to start with small goals. A first goal that I tell people is start off with just breaking even, taking a trade just to see how you can buy and sell and just breaking even. Then you can start focusing on making 1% a day, then 2% a day, and so on and so forth. Also, now we're going to talk about some other ways you can avoid the PDT rule. So most of you guys are worried about the PDT rule, so I really want to cover this topic. Okay, so what are some other ways? So if you want to stick to your margin account because you want to trade more than just $1,000 you have, okay, what are some other ways we can navigate the PDT rule? First of all, we talked about this cash account, and that's the one I recommend. Next, multiple brokerage accounts. So what does that mean? It means, let's say you either didn't sign up to just Robinhood or just Webull or just TD Ameritrade. You sign up to all three of them. You save $1,000. You put $333 in each of them. So then you have 3, 6, 9 day trades. 9 trades for $333 each. Right, and that can be good. If you're good at switching a broker, comfortable with a lot of brokers, I don't recommend it because I like to stick to one broker that I'm really good at and I know how to master and I'm fast with it and stick to that. But this is another popular strategy. Also, you can trade things like futures. If you're not familiar with futures, then don't even worry about this. But you can trade futures and future options. Those are not covered in the PDT rule. And another thing you could add with the futures is trading cryptocurrencies. So you can trade Bitcoin, things like that. Those don't affect under the PDT rule as well. So it's good, and they are also 24/7, so you can trade them over the weekend too. And lastly, the main point is do not overtrade. If you're not over PDT rule, most likely you're going to be a new trader, a trader that does not have too much experience, and you honestly just 3 trades a week are perfect. Finding a perfect A+ setup doesn't happen every day. So 3 times a week, yeah, it can happen 3 times a week. So I will focus, if you're a new trader, look for the A+ setups. If the setup looks perfect, only take that trade. Be very objective on what if you do really is it a good setup or you're just excited to trade. What happened to me and what happened to most traders when you're first starting out, you get your broker set up, it's Monday morning, 6:30, and you boom, first thing you see, I want to trade, I don't want to miss out. Next thing, I want to trade, I don't want to miss out. And you're going to take like 20 trades within the first hour of your first ever trading day. Should you do that? No, because you're not experienced. You don't know exactly. You're just so excited. It's like a new toy. You're like, finally, I get to day trade and I get to apply what I've learned. And you end up overtrading and you're taking bad trades most of the times. You don't want to overtrade. You're going to notice that a lot of the high level traders take less trade than you would think. So they might only take a few trades a week even. I've seen traders that take 1 or 2 trades a week and they make millions of dollars yearly. Why? Because they only wait for the perfect setup and they go and are patient. They're calculated, And quality is always better over quantity. You don't want to over trade. I'd rather take one really good trade a day than 10 mediocre trades a day. Right? It minimizes risks and gives the most confidence it's going to work, and it minimizes my emotions. So please focus on do not over trading. Maybe the PDT rule can be a good thing for you if you're a really beginner trader. So these are some ways you can navigate around the PDT rule. I recommend starting a cash account. And also what I recommend is for you guys to focus on the setups more than the emotional. So start off with a smaller amount of money in the beginning and then slowly size up your account the more comfortable you get. And I'll see you guys in the next lessons.